Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today, we have Agostino Pintus. Over the past 2 decades, he has been involved in over $350 million worth of real estate investments and specializes in large-scale multifamily development projects, acquiring apartment communities, single-tenant net lease assets, and office buildings. So thank you so much for being on the show today, Agostino.
Charles, thank you so much for having me. Appreciate it. Seeing you again.
Yeah, it's great to connect again. I was on Agostino's podcast a little while earlier, so it's great to turn the tables here.
Yeah, absolutely. Absolutely.
So give us a little background on yourself, both personally and professionally, prior to getting involved in real estate investing.
Sure. So yeah, like you said a second ago, back about 17 years ago, I was working in tech. I was a corporate executive working in my W-2 job, doing all that. And a friend of mine said, "Hey, you know what? You should do real estate." So went on a whim and started buying like small multifamilies, single families, stuff like that. And I was doing all that while I was working the corporate job, and I was managing it, doing all that fun stuff. Well, there's only so much you can do of that. And but at the time, I didn't know much of anything else about syndication or anything of those things, right? But this is back before 2008. When 2008 I put the brakes on everything, stopped buying single families and small multifamilies, and kind of like took a long hiatus from doing real estate. But it wasn't until I was working back in corporate and ended up getting, I'm not a good employee, right? Definitely not a good employee. And I ended up leaving another company, and I'm like, what the hell am I going to do now? And I remember that despite all the problems I have and that with working in corporate and the ups and downs and all that kind of fun stuff, it may be someone out there that might be in the same position, right? My real estate always produced. It always made money. So I'm like, you know what? I need to figure out how to do bigger deals. And I had a friend of mine who explained what syndication was. I had no idea what syndication was. And he explained it to me. I'm like, it's about raising capital, register the asset register the deal with the SEC, all that fun stuff. And I'm like, I could do that. So I started working on it, then partnering up with people. And next thing you know, I'd say, really put the accelerator on probably about, 5-6 years ago, and partnered up with the right people and started building the business up, So now, aside from doing acquisition, we also focus on development, adaptive reuse, ground up, that kind of thing. And we also do single tenant net lease. We have a fund that acquires single tenant net lease assets like Dollar General, Dollar Tree, Walgreens, stuff like that. And the intent of that net lease fund is to give us and our investors steady streams of monthly income. That's what that does. It does it very, very well. It's extremely predictable, right? So yeah, it's like, that's what we do now. And we're just focused on those 3 lines of business. We also have an education business as well. But, it's like with the education business, it's all rooted in actual real life experience that yours truly runs. So it's kind of a big deal,
Yeah. It's hard to find the teachers that have actually been through a recession and everything like that. Everybody's been writing it up for the last 10 years. And then we got a little distorted on top, and then that's where we are now. But so very interesting. You have a lot of different assets you're working with. Let's talk about the triple net lease fund, a little bit about that, because it's something we don't talk about too much on the show, but it's a very interesting asset class. I've never been on the GP side of it. I have been on the LP side of it. So can you explain a little bit about actually what these properties are, who these tenants are, and how you go about it?
Well, Charles, I love net lease. Net lease is freaking amazing, and I'll tell you why. I mean, you already know why. But the great thing about the net lease assets that we're buying, so these are very specific types of assets.
Can you explain, I'm sorry, explain what net lease is before we start.
Yeah, sure. So net lease, when we're talking about net lease, people often refer to it as triple net. All right, the 3 nets: taxes, insurance, and maintenance, right? Those people are referring to 3 nets, right? But these days, it might be double net or a single net or whatever, right? Depends on what it is. But net lease in general is an asset, a commercial asset that someone's buying, and the tenant is paying for those 3 things, or 2 things, or 1 thing, depending on what the lease actually says. All right, so that is a real cool thing. Now, the amazing thing in a deal like this, though, is that when you have a corporate tenant, and you have a tenant with a corporate-backed guarantee, and you have a big tenant like it was a publicly traded company or some sort of large franchisee. So think of Dollar General, Walgreens, Burger King, Pizza Hut, like companies that have been around for a long time, and they're not going to die tomorrow, right? Those are the types of deals that we're doing. And the mechanism that we use, though, is a fund. So we use a blind pool fund. When we get the LP investors to come in, and then we go and buy these assets. Now, why would these LPs even want to do something like this? Because you get steady cash flow backed by a corporate tenant who's been there for some length of time and will more than likely still stick around for some period of time in the future, right? So when you can hang your hat on that monthly cash flow, because then whenever the rent comes in, we do a distribution, right? So the monthly rent comes in, we do the distribution. That's basically how it works. It's a phenomenal way to have monthly steady cash flow backed by a corporate guarantee and a tenant that's not going to bounce tomorrow, right? You don't have to worry about that. Like in multifamily, you have to worry about stuff like that. You have to manage the vacancies, manage the evictions, all that fun stuff's part of doing the business. Not poo-pooing multifamily, but when it comes to net lease, you don't have to worry about those sorts of things, at least not at the onset. If you do your underwriting properly and you go through the lease, it becomes lesser of an issue.
Right. So with the assets you're buying, if you're getting large national tenants, I imagine these are pretty high quality assets and that you're buying. Do you deal with anything that maybe is sub premium, maybe like, that where you're getting asset or you're getting maybe regional tenants, smaller tenants going into them, or do you stay away from them?
Yeah, we stay away from that stuff. We stay away from it. Right now, we're staying away from the strip malls. We're staying away from we're staying away from the regionals, that kind of thing. Like we just bought a VCA animal hospital, actually, right? Mm-hmm. So why would anybody buy a VCA animal hospital? You've heard of it, I'm sure, right?
Yes.
VCA animal hospital. Well, here's the thing. VCA Animal Hospital is it's a corporate tenant. It's a national. And you know who owns it, right? Mars Company. The guys who make the chocolate bar. Yeah, they own that. And Mars owns a bunch of other stuff. There's a massive company. People don't know that. But there's a corporate guarantee in that store. Corporate guarantee on that location. It's an animal hospital, and they were open through COVID. So many of the assets that we're looking for that we buy have survived COVID, which is probably one of the worst events that could have possibly shut down the retail space. If it could stand through that type of scenario, then we're very comfortable continuing to buy those types of assets. If you're going with a regional or going with even an independent store, like a hair salon, like JoJo's hair salon up the street or whatever, unfortunately, JoJo was forced to shut down during COVID. Bovrix wasn't. Bovrix was open. Yeah. Right. So it's like, is it unfair? Yeah, it might be unfair, but you know what? It's like, sorry, I didn't make the rules. We're buying the assets that can stand through those types of events. So that way, the investors are still getting that steady stream of income. That's ultimately what our bar is when we're looking at stuff like this.
It's like buying A-class multifamily versus C-class or B-class multifamily. And there you're going to get lower returns. However, the asset's going to be as closely correlated to, I hate to say this, but like maybe a treasury where you're up in that security. Because let's be honest, if a large tenant like CVS or Walgreens or one of these other people, if they're having financial issues, there's going to be major financial issues that are happening in the United States. So that's one thing. Because I've spoken to people. We had somebody previously on the show that was he would deal with smaller strip malls and stuff like this. And I'd always find out, how do you vet the tenants, and also how are you reviewing their leases? Because I mean, it's much different. If a multifamily person, the key there is that you don't have to worry about the inflation escalators because it's a 1-year lease. You're getting into more complicated leases. Now we're worried about, everybody's been worried about inflation. They just realized it about the last 24 months, but it's something that wasn't an issue before. Now it is. And so now it's like, if I have a lease that has 8 years left on it, now it's something that I have to really worry about, because when they signed it, they probably weren't worried about it. You know what I mean? But interesting, very interesting. So how are you guys picking, or go on? Sorry.
Yeah, no, I was going to say that's a very good analogy. It's like a net lease is very similar It's like an A-class type of asset. I think that the main difference here is that cap rate, when people refer to cap rate on multifamily or even development for that matter, where there's people that live at these assets, cap rate is used incorrectly, in my opinion, right? Cap rates is generally used in commercial, but when it comes to these types, when you're trying to do a cap rate on a C-class asset, cap rate implies that it's going to be a steady return no matter what. It just doesn't work that way with C-class because you have people that live there. People are not predictable, right? And to use a cap rate to define revenue is stupid, if you ask me, right? It's dumb. All it does, now, cap rate will tell you the level of risk of an asset, right? If you're buying a C-class asset or a D-class asset in a bad neighborhood, it's a 10 cap, and people get all excited about it. You probably shouldn't get excited about it. It's a 10 cap. It means it's a high risk deal. The higher the cap rate, the higher the risk. The lower the cap rate, the lower the risk. In net lease, it's different, right? The cap rate defines the same sort of risk level, right? But to your point, it's extremely predictable. Are you going to become a billionaire off of net lease? Probably not. But you know what? It's steady return. In times like where we are right now in the economic cycle, and you don't know if you're going to have a job in 6 months from now, if you're one of those people that don't really know, it's like, do you really know how steady your company is? Maybe you don't know. You might get the box. You know, the box. We talked about the box, I think, on our show, right? The GTFO box. You might get the GTFO box, right? And if that's the case, most people, what they'll do is they'll invest in net lease, a net lease fund, to make sure that money keeps rolling in no matter what happens. Yeah. Right. So it's a great way to do that. And I think you asked me about leases, right? Just a second ago.
Yes.
The leases are where everything begins and ends, because it's funny how people refer to net lease as like, oh, it's a triple net lease. It's triple net Dollar General. It's like, and then you look at the lease, it's not actually a triple net, right? So I think it's translated from many years ago when everything used to be triple net, right? And the triple net was, I shouldn't say everything, a lot of deals were triple net, right? Where the tenant was responsible for everything, the taxes, insurance, the maintenance, everything, right? And I think over the years, to try to offload some of the risk for the tenant living there or using the space, they would make it responsible for the landlord, us as owners. Well, you still have to read the lease. The lease says everything. And we've looked at deals where it's literally the same, the same store, right? Same Dollar General in the same area with two different leases, right? But because they're signed at two different times. It's bizarre, right? And one deal was actually great, the other one was not so good, right? Because of the nets that were in there, right? Like, we never want to be responsible for taxes. It's too unpredictable, right? Yeah. Maintenance is one of those things. Yeah, we don't mind doing the maintenance stuff. Depends on how the condition of the property. So we'll do a PCA report. We'll understand. We'll get an idea as to how much money we have to set aside for that asset, and put it in reserve for the entire fund. I mean, there's different ways of doing that kind of thing. But I think the difference, though, that we do in our deals is it's our background. My background, as I alluded to, is tech, is IT. And my wife, her background is data science. So, and we have our partners that also, they do sales and marketing. It's a great combination. We apply a high amount of data technology to determine the viability of an area, how strong it is, how many people are visiting that property every single day. We look at stuff like that, right? Yeah. And we pull it onto a database and we visualize it and we see, like, what is the probability of that person, of that tenant bouncing or sticking around for the long term, right? So these are all things we look at, and we do this without even asking for any type of information from the tenant. Sometimes they give it to you, sometimes they don't. Sometimes they give you their financials for the store. Sometimes they do. Most times they don't. They used to a long time ago. They would just hand it to you. Now they don't do that. They got to do got to deal with what you got, right? Yeah. So the data will tell us.
So are most of your deals now going into a double net situation where you're offloading taxes and insurance to them and you're handling maintenance?
For the most part, we get a lot of those deals. We do. Yeah. I mean, so it's funny. I looked at a triple net deal. It happened to be here in outside of Cleveland, actually, in a nice area called Parma, and it was for a bank. And it was a triple net, and I went to go visit the property. and the property was a complete disaster. The asphalt hadn't been fixed. The building itself, like it was brick, right? But it hadn't been pointed, or it needed all kinds of work. That had been taken care of. You can tell some of the wood was rotted. I mean, it was terrible. And I think the lease is probably going to be up in like 12 months. So it's like, this doesn't give me confidence that if they're responsible for the maintenance and they haven't even maintained the asphalt or the building itself, are they going to stick around? Probably not. I'm not taking that gamble. I've not visited that property since. I should probably just go by and take a drive out there just to see if they're still there. Yeah. But it's too much of a risk. Like, we won't do deals like that. If we think it might be risky, we just won't do it. We just won't do it.
Yeah. So one of the great things about this net lease type business I see is that you're offloading a lot of high cost variables off to the tenant, like taxes you don't deal with, insurance. I mean, I'm in South Florida or Florida. Do I have to even explain that to anyone? Anybody with anywhere where there's been inflation, which is the whole United States, there's been some sort of issue. Before selling up a portfolio I had in Connecticut a couple of years back, I mean, right when I was selling it, my insurance went up 8% in Central Connecticut. You know what I mean? There's no issues per se there. It's just inflation. So you're offloading those big ticket items because taxes in some places, there's some sort of control on that. And you know how high it might go for certain properties. There's sometimes a cap on it. Inflation, interest, insurance, there's not. So that's one thing that I find very interesting too with the asset class. So for people that want to tap into this business, getting into net lease properties, tell us about how you really go about someone going into a new market for yourself, let's say, and you're choosing a market and you're building teams there, or are you partnering with someone already there?
No, that's a good question. I cover some of the stuff what I'm about to say on an ebook that I have, GI226.com. If you go there, it's a free ebook. Go ahead and download it. I talk a little bit about this stuff and selecting the right type of assets, but we don't really partner with any individuals on site. We don't have to, right? That's a great thing. That's another great thing about net lease, right? So generally, and not to turn this into a political situation here, I'm not doing it, but we buy in red areas, we stay away from the blue areas, right? We'll from time to time, maybe we'll look at a place in Chicago or something like that. Depends on where it is, depends on the density. There's a lot of dependencies, right? Like if there's a lot of traffic in that area, there's people, there's money, maybe we'll consider it, but it has to be an exceptional type of deal. We look at average income. We look at, depending on the tenant, of course, and some of the tenants, Dollar General, Dollar Tree, Animal Hospital, the type of assets. That's what we're buying these days. We're getting into the CSV, the CVS, the Walgreens, the pharmacies. We're getting into that too. But we're looking at income levels for that as well. So again, it's very similar. Crime stats, and we look at how much activity is in that market too. We also look at flow of traffic, vehicles per day, a variety of things like that, how busy that area is. But one of the things we always think about, and this is the thing that I thought about from the very first time I did my very first deal, how fast can I unload this thing? Yeah, that's the first thing I think about. How fast when I bought my first house, my very first piece of real estate as a rental, how fast can I unload this? That was a rule that I came up with, meaning if something happens to this property, meaning this Dollar General decides to shut down, how fast can I put another tenant in here? That's what I think about, right? So if we're typically looking for the right square footage, the right location. If the square footage is too small, we don't consider it. It falls off immediately. If the lease is short, but we have reason to believe they're going to renew, we'll do that deal. Usually we go out and see the property personally, right? We'll either drive there, fly there, whatever, But for the most part, due diligence is extremely important when you're doing these deals. Because that is the most amount of leverage you're ever going to have in any deal is due diligence. And if your due diligence sucks, you're going to have a lot of problems down the road because the leverage is gone. Now you have to work with what you got. so you better have a lot of reserves if you're going to do it that way. Right. But like I said, the ebook covers some of the stuff too. So yeah, definitely check that out too.
You brought it up. How long does it take to really rent out one of these places, lease out one of these places when they go vacant?
Yeah, that's a good question right there. Right. That's a scary thought, man.
Scares me right now.
It is. And it's funny because I'll give you an example, right? So we're looking for vehicles per day because if there's a lot of activity, a lot of traffic in that market, hopefully it might lease up in a year, right? I mean, if you do okay, if you know they're going to be bouncing, you can start lining up the relationship with a big national. That's typically who I would go with. It just depends on how big the broker is in the market. Just like in multifamily, there's we talked about it a second ago, A, B, C, and D class assets, right? There's also A, B, C, D areas, A, B, C, D brokers. What does that mean? Well, some brokers, they only like doing certain assets. And they're really good at doing certain assets. Just because Colliers is big in this market here in Cleveland, Colliers may not be big in Cincinnati. And in fact, they're not. Out there, it's CB Richard Ellis. Or CBRE. Right? So it's like, it just depends on who is the dominant player in that market. And usually they will get the right tenant for the asset if they have a big net lease practice. These are all things that you really have to understand. There's I spoke to a friend that he brought an investor on a call. He was asking me questions about doing a net lease asset in my hometown in Windsor, Ontario, super small town, and it wasn't going to have a corporate guarantee. I think it was like a single location. It was a Quicken Loans. That's what it was. It was a remote office in Canada. It'd be the first and only office that they would have outside of the United States. And I'm like, okay. And you want to build it out, like you have to buy the space, build it out. And how long is the lease for? Only like 3 years.
Wow.
And it's like, and I grew up in this town. I knew that there's so much vacant space. I told the guys, like, go downtown right now and count how many vacant spaces there are. What makes you think that it's a good idea? Like, why would you do that? You're right there. You're right downtown. Why would you do that? So it's a high risk deal. Don't do that deal. So we look at stuff like that. We look at how much other vacancy is in the market. What is like, if we have an understanding is what is the cost per square foot? What is it leasing for? What is our subject asset leasing for too? Is it below? Okay, great. That means that chances are they'll stick around, if they want to stay in that market, I mean, these are all things that you have to look at when you're putting a deal together, so absolutely we look at stuff like that, and because there's a lot of risk in taking on an asset and you realize it's not going to renew and you're stuck with it. I mean, I'm sure you've been to those towns when like half the town is empty,
Yeah.
Retail is tough. It's a tough business.
My dad had a partner years back, and I remember him telling me when I was younger, and he said, commercial real estate's great when it's occupied. It's very expensive when it's vacant. And that's like my mantra I've heard I've kept in my mind for every time anything like this happens with commercial and you're talking about it. But, and it's exactly true because you have these multi-million-dollar properties with maybe 1-2 tenants. And then if it's a single, so it's just, it can be very expensive. And everybody knows those sites you've gone through with like a premium property that's been vacant for years because it's difficult to rent, or they're doing something else, or they're looking for the right tenant. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So Moving along here, so with new and well, it could be new investors or just investors in general. I mean, what are common mistakes you see triple net lease or net lease real estate investors make maybe when they're starting, or maybe even actually when they've been doing it?
Yeah, sure. So I will say this, that they don't take the time to learn it. They just want to get in, and they want to get in without any partners. The same thing happens on the multifamily side, and there is a way to get into this and reduce the overall risk. And the way you do it is to buy into a fund, partner on a fund. Because like I said a second ago, or you said a second ago here, it's like commercial is great when it's occupied, but then when it goes dark, people leave, it sucks. It's bad, right? Well, in a net lease fund, we might buy like 10 or 15 or 20 or more of these assets in a single fund. So what happens is if there's 9 or 10 of these things, and then one of them, say Dollar General decides they're going to leave a market, well, the other ones are still producing cash, right? So this DG right here is only a part of it. Does it suck? Of course it sucks. But we as the partners, we get to work trying to backfill that vacancy, right? That's a great way to help offset the risk even a little bit by spreading your money across multiple assets that are still producing money, so that you're not invested entirely in one asset. And if that one asset goes dark, you're screwed, So that's the last thing you want to do. You don't want to do that, especially if it's going to be your nest egg for you and your family in times of trouble. The last thing you want to do is have that the store that you bought, the DG that you bought with your own money, suddenly go dark. Now what the hell are you going to do? And it's a big worry. It's a huge worry, because renting, to your point, we just said a second ago, leasing this stuff out is not easy. It's not. It's a thing. It's a challenge. It really is.
Yeah, I can imagine. So with dealing, every time I know people that have clients that are large, Fortune 500 companies, and they wait months and months and months to get paid on stuff. So you imagine how long it takes them to make a decision on leasing a property or whatever they have to do with it. So Agostino, you've been doing this for decades, and you were in tech before. So kind of over your whole, let's say, professional career to now, how has your relationship towards money changed over that time?
That's a great question. When I was working in corporate, I was living the 40-40-40 plan. I think, and I think we talked about the 40-40-40 plan last time. We might have talked about it, right? It's when you work for 40 years, 40 hours a week, and you only get 40% of your money because the government stole 60, that is the most expensive way for anyone to earn a living. If there's an expensive way to do it, that is it. What do I mean by that? Well, the W-2 income is the highest taxed method of making a living. Isn't that strange? So what is one of the lower ones? Passive income. Passive income is taxed at a lower rate. So what does that mean? That means there's an incentive to invest as opposed to working for a living at a W-2 job. That's what it means. But it's not presented in that way, right? I didn't know this, right? I thought investing was doing, your stocks and bonds and mutual funds, which is it's not good. It's not good doing that. It's a risk, if you ask me. That's why I chose real estate. Because here's the thing. Here's the ugly reality. Okay, Charles, you and I buy 20 grand worth of Apple stock today. Say it's May the 1st. What is that Apple stock going to be valued at the end of this month? Do you know what the cost is? 20 grand. What's the total amount going to be worth at the end? Do we know?
No idea.
No idea. But if we have a multifamily asset, or we have a net lease asset, or a group of net lease assets, if we're expecting to get 20 grand on the 1st, what's it going to be and what's it going to be in June 1st? 20 grand, right? Why? How can I say that with such confidence? Well, I got a bunch of legal documents called leases that say that if they don't pay, I can come after them. It's a legally binding document that I can go after them. I can either evict them, I can take some sort of a legal remedy to collecting that money. You can't do that with stocks, right? And when you get to understand all of the depreciation you can take on your personal income, it's an amazing tool. And now more than ever, you have to do that. Like the value of the dollar is dropping like crazy. You need every advantage you can get. I didn't know this stuff. I figured it out on my own. In the W-2 world, HR is pushing this nonsense of like, 401k and all this stuff. I mean, listen, sure. Okay, great. Max out your 401k. Don't leave that money on the table. Fine. Do that. But as soon as you're able to move some of that money to a self-directed IRA and start taking control of your money, you should always be in control of your money. Why would you want to let someone else that you don't even know control your cash? This your family livelihood. Why would you ever do that? Right? Yeah. It's ridiculous. You want to partner on an asset. You want to make a decision to buy a property and then understand what the plan is. And you're an active partner and we're going out and buying properties. Yeah. And you get all the appreciation, get everything along with it. Why wouldn't you do that deal? Makes sense to me.
Yeah. The 401k thing is always something because I've had, friends, acquaintances, they'd ask for assistance with their 401k or whatever, and you just look at it and you're like looking at the returns and I'm like, this is how much money you have here and you have so many years left. Like without doing anything like what you're invested in here, and this sounds like a great thing, this target date fund or whatever it is. I mean, you need a lot more money right now. This will work, but most people get started in their 30s doing it. You know what I mean? And you've lost such an advantage with it. So it's just, you don't want to, it's good that people are retiring. I mean, putting money away for retirement, but I never think it's enough. So it's always something that if they move into something, because it doesn't earn enough, you know what I mean? And it's still, unless you start it when you were 18, you know what I mean? It's, with a Roth IRA or something like that, and you're putting it away, maybe you'll be fine. But it's something that most people start and really start padding it up when they're in their 30s. And, that might be too late, you know what I mean? Especially depending on with inflation and everything like that. But
I'll tell you what, Charles, it's rather cool to see some of the students that we have coming into our programs. They're in their 20s, some of them. I spoke to a guy, a student yesterday, actually. He's going to be signing up for Accelerator. He's 23 years old, and he wants to learn how to syndicate big deals, right? Amazing. 23 years old. Really, if you think about it, if he could syndicate just one multi-million-dollar deal, and this as well as I do, because we do this, right? You buy one deal, the second deal is going to be right behind it, third deal is right behind that, and you can expand. You could basically be retirement ready before you're 30 years old if you do it properly. Same thing goes with our small multifamily business, or rather coaching group. It's like, even if the kid starts house hacking today, he's in a way better position. But again, we're all taught. I was taught the same way. I don't know if you were. Go buy the giant house, take on this massive expense, go buy 2 cars, take on that massive expense, and go to work for 40 hours a week plus, actually. Ridiculous. No, I didn't know that. I should have taken all that money. I should have moved into an apartment, stayed in the apartment, make a bunch of cash, and then buy a multifamily.
Yeah.
That's what
my first property was a house hack at 22, and I didn't do it as lavishly with going into syndication and everything afterwards, but it was a great starting point, and it's a great way for anybody that's starting out to follow that. And it's so simple. Yeah. And how many people I told in college to do that, no one took me up on it. And, it is what it is, but no one wants to listen. They want to go right. You said people want to start at the top and work sideways. No one wants to work from the bottom up or live in an apartment with their tenants next door. So
no, it's hard. That's the thing. It's hard. It's hard, but you know what though? It's like, that's the tough part. It's difficult if you make it difficult. When you begin to understand how it works, how apartment living is not house living. Absolutely. It's not. But you know what? If you take a little bit of suffering, air quote, suffering today, if you consider it suffering, I don't. I live in an apartment right now. I think it's great. I don't have to worry about anything. I don't have to worry about cutting lawn or shoveling snow or any of this nonsense. I just live my life, and someone even comes to fix my stuff. How is that so bad, right? But you know what? What I am focused on is taking all this cash and putting it to work. And then when the assets are producing cash flow, I can go and live the life the way that I want to live it, as opposed to having a bunch of dead equity sitting in a house. Ridiculous. Yeah. It's ridiculous. Why would you leave $500,000 or whatever tied up in a house that you can't do anything with it?
Yeah.
It's dumb. Doesn't make any
No.
sense.
No. It's kind of what we've been taught and what realtors have been pushing on us for decades.
Yeah.
But
And the banks too.
Yeah.
The banks are able to take that single dollar, multiply it 9 times. Now they have all this inventory. What do? We sell the American dream and sell the same dollar 9 times to everybody and get them to buy into this whole single family scenario.
Yeah.
It works well for the banks. They're the landlord.
Agostino, how can our listeners learn more about you and your business and your coaching and your triple net lease offers?
Yes, absolutely. So if you go to bulletproofcashflow.com, it's a portal that talks a little bit of some of our coaching. It does talk about some of the investment opportunities as well. We only deal with accredited and sophisticated investors right now. But set a time if you want to talk about that. Absolutely. And like I said, Guide to Net Lease is a great way if you really want to understand how net leases work. It's a great book, and the content that we put out, I like to think is top notch. It's a very complete book. It's not just like a pamphlet just to get your email address. It's an actual book that you can read and actually learn from. It's good stuff. It won't disappoint. It's always good stuff.
And also your podcast, Bulletproof Cashflow, as well.
Yeah. We have we're on all the major channels on YouTube as well. If you want to watch the video, YouTube.com/Bulletproof Cashflow. We have over 700 videos right now, various things, everything from net lease to development to multifamily. We talk about a bunch of different stuff. Definitely check that out. A lot of great material there too. Totally free, obviously.
Yeah. Well, thank you so much for coming on today, and looking forward to connecting with you here sometime in the near future.
You bet, man. Thanks for having me on.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.